Meet the Johnson family. Dad, Mom, brother, baby Thomas, and dog Spike. Here's the deal. The Johnsons have fallen behind on their mortgage payments, and now their lender wants to foreclose on their home. But the Johnsons don't want to lose their home, so what are their options? Well, let's see if their lender can offer help by looking at the different reinstatement options available. First, the Johnson family's lender may suggest a refinance. This is a great option if the Johnsons are not yet past due on the loan and have a strong credit history. However, a refinance is not an option if their credit is damaged. And unfortunately, the Johnsons' credit is too damaged at this time. So their lender moves on. The next reinstatement option is a reverse mortgage. This is a loan in which the lender makes monthly payments to the Johnson family instead of the family making payments to the lender. This loan would allow the Johnsons to turn the equity in their home into income, which is sorely needed at this time. But there are a couple of glitches. The Johnsons must be 62 years of age or older to get a reverse mortgage. In addition, they would have to refinance to pay off their current loan to get this new loan. Unfortunately, the Johnsons are not 62 years old. Plus, we already established that their credit isn't good enough for a refinance. Therefore, this option won't work either. So their lender looks to the next option, which is a partial or advance claim. This only applies to FHA mortgage loans. Now, an FHA loan is insured by the Federal Housing Administration, or FHA. The FHA provides insurance to approved lenders on FHA loans sold to customers. This means if you fail to make your payments on the loan, the FHA pays your lender. With a partial or advance claim, the FHA would agree to make a one-time payment to the Johnsons' lender. This advanced amount would cover all or part of what they owe, so the lender can reinstate the loan. Then the Johnsons sign a promissory note to repay the FHA for that amount. What's great is they would pay little or no interest on the advancement, and they don't have to repay it until after they sell their home or pay off their FHA loan. But to get this option, the Johnson family must demonstrate that they resolve the cause of their late payments. In addition, they must show that they can resume making normal payments, and that they do not have enough money in savings to repay the amount they owe to the lender. Usually, lenders offer a partial or advance claim only if a loan modification, repayment plan, or refinance will not cure the loan. And the Johnsons' lender is thinking a loan modification or repayment plan may be the answer for the Johnson family. But before the lender looks at these two options, he wants to look at forbearance first. Now, forbearance is the least common reinstatement option. It involves the lender delaying or reducing the Johnsons' normal payments for a fixed period of time. Then, at the end of the period, the Johnson family must repay the entire amount they owe through a payment plan. The Johnsons' lender may consider this option if the cause of the overdue payments is specific and temporary, such as an illness. It may also consider it if there is reasonable evidence of the family's ability to resume their mortgage payments after the fixed period. Although this could be a workable option for the Johnsons, the lender thinks the last two reinstatement options may be better. The first of these options is a repayment plan. A repayment plan can help the Johnsons become current on their mortgage payments over time. The plan can extend from 2 to 18 months. However, before the lender agrees to this plan, it may require a good faith payment. This payment is usually equal to 1 month's payment under the plan. So how does the lender figure the new payment under the plan? Well, let's figure the Johnsons' new payment. Their current payment is $1,000, and they are behind 4 months, therefore they owe $4,000. But they also owe late fees, interest on that $4,000, and so on. Now add all of these items together. Then, take that total amount and then divide it by 12, which is the length of the Johnsons' repayment plan. Finally, add this result to the Johnsons' normal payment, and you get the new payment under the plan. The Johnsons' lender likes this option, but wants to look at one more, a loan modification. A loan modification is the most successful reinstatement option. With a modification, the Johnsons' lender changes one or more terms of the loan, such as the type of loan, interest rate, repayment amount or the length of the loan. This may be the right option for the Johnsons if their loan is more than 12 months old, the changes make the payment affordable, and their income supports the new payment. However, they need to be aware that their lender may add the total amount overdue to their loan balance. But before the lender agrees to a loan modification, the Johnsons may have to provide a good faith payment, pay a fee, and show their ability and willingness to make the payment on the modified loan. So the Johnsons' lender thinks either a repayment plan or a loan modification may work best for the family. After crunching the numbers, a loan modification offers a slightly lower payment than the repayment plan. Therefore, the Johnsons and the lender agree to the modification. What a relief! The Johnsons just avoided a foreclosure.